instrument and derivative market features. This is the second video for this learning module. In the first video, we talked about the derivative features, and in this second video, we're going to talk about the different underlying assets that can be there for each type of derivative. And then in the third one, we will talk about the features of the derivative markets. Now, you could have derivatives for stocks, right? Where you are saying, I will buy this stock in the future and I will pay you in the future. You can have them for bonds. You can also have them for interest rates. So in case you have a very large project and you've borrowed money for that and you're worried that the interest rate might go up, right? So you can get into a derivative contract as a long party. So if the interest rate goes up and you're long, then you will have a positive benefit from that situation. Currencies, you're worried that, let's say you're investing in Mexico and you're worried that the Mexican peso might become strong compared to the US dollar. So you can go long the Mexican peso. So this is also possible for currencies. Again, commodities, let's say we talk about oil, and remember the example from the previous video for the American Airlines, that American Airlines is issuing tickets and they are worried that the oil price might go up in the future, so they can buy oil using a derivative contract in the future. Credit, so think about a bank that is giving loans, and let's say they are giving a very large loan. A bank is giving a very large loan to, let's say, American Airlines. And they are worried that what if American Airlines goes bankrupt? So what this bank could do, it could get into like a derivative contract, let's say, and you can think of it as like an insurance policy. So they can maybe talk to American Insurance Group and they can ask them that, okay, in case American Airlines goes bankrupt, then in case American Airlines goes bankrupt, then obviously they will not be able to get their loan back. So the American Insurance Group will pay the bank back in case this happens, right? So this is a kind of insurance you can think of. And this is a derivative on credit, because this loan is a credit extended by the bank to the American Airlines. So let's talk about the stocks first. Now, this can be based on an individual stock, and think about the Amy Investments example, right? That we had talked about in the previous video, where they were agreeing to sell the shares of Airbus. And that's one individual stock, right? The same situation can be there for a group of stocks or something which is called an index, which is like a combination. So one of the most popular indices is the S&P 500, right? Which is a combination of 500 different stocks. Now, it doesn't have to be a forward, it can also be options. So remember in the previous video, I told you about Amy Investments can buy a put option, which gives them the right to sell Airbus shares at 30 euros, right? That is one example of how companies that are investing in stocks can safeguard their position by getting a put option so that they're able to at least sell at a certain price. But options are used by companies as well. And so a put option, what we discussed in the last video, so this is the example from the previous video, from the last video. We talked about them also using a put option where they had the right to sell at 30 euros, right? But there is another type of option which is called a call option. Now, a call option if you buy this, it gives you the right to buy. And let's say that could be 30 euros as well. Now let's say Airbus company is giving this call option to its employees. They're giving this call option to their employees to be able to buy the share for 30 euros. Now, put yourself in the shoes of Airbus employees. If you have the right to buy the company's share at 30 euros, what will you try to do? Let's say you work very hard. The employees, they work very hard. And they improve the performance of the company. And what that makes happen is that the stock price goes to, let's say, 50 euros per share. Now, since they have the right to buy at 30, and if it goes to 50, they can make a 20 euro profit per share, right? So options, specifically call options, are used by companies as compensation for their employees to motivate them, to encourage them to work hard and increase the equity value of the company. And they are used, and put options will be used by investment companies to safeguard their investments so that they have a right to sell at a minimum price. And if it goes up, obviously they will not exercise that right. We talked about this in the previous video. They'll sell at the higher market price. But if it goes down, at least they have a minimum price they can sell at. So their loss is limited. Now, index swaps, also known as equity swaps, allow investors to pay the return on one stock index in exchange for return on another index or interest rate. So let me give you an example here. Let's say I am in the US and I want to invest in India in the Sensex, which is the index of the Indian stock market, but I don't want to send my money over there, right? So what I do is I get into a deal which is called an equity swap, that somebody sitting in India is going to pay me whatever the return on the Sensex is, whether it is positive or negative, whatever it is, they will pay me. And all I have to do is pay them the return of the New York Stock Exchange, because my money is invested in the New York Stock Exchange, and whatever return the New York Stock Exchange makes, I will give them, and they will give me the return of the Bombay Stock Exchange, whether it goes up or down. So without actually taking my money out of New York and taking it to Bombay, I can sit in New York and still get the return from Bombay by getting into this equity swap. Let's say they don't want the return from New York Stock Exchange, then I can just pay them a fixed interest payment as well for whatever amount of money they are investing in the Bombay Stock Exchange for me. So it can be in exchange for the return on another index, let's say the Nasdaq or the S&P, right? 500, or even they can just get a fixed interest payment if they don't want the return from another index. So this is a equity swap. Now, derivatives are also available. So I should say here, also available based on the realized volatility of an equity index instead of the direction. So let's say I am worried that something big might happen in the world and the stock exchange might go up a lot or go down a lot. I don't know if it, let me give you an example. So if you might remember, some of you might remember a few months back, almost more than 2 years back, actually, there was the meeting between when Donald Trump was president, and he was having a meeting with President Xi of China, and they were talking about trade tariffs that US was planning on increasing the tariffs for China. Now, we don't know what the outcome of the meeting is going to be. Maybe they will come out of the meeting saying, oh, we've decided that we are going to have a very good trade. Or they might come out of the meeting and say, oh, we've decided that we are going to have very bad trade and we are closing the trade on both sides. So if they come out and saying that, oh, the trade will be very good, the market will go up. If they come out saying the trade will be very bad, the market will go down. but we don't know what will happen, right? We don't know the direction of the change, but we know that something big is going to happen. So you actually have derivatives available which are based just on the volatility. And so there's something called the VIX, right? There's a VIX index which goes up when there is high volatility. So you can actually get derivatives based on that as well. Now, coming to the bonds, uh, governments have lot of similar bonds outstanding, right? I mean, especially if you look at the U.S. government treasury bills, there are so many treasury bills outstanding. So when you actually want, you're worried that maybe the interest rate, the US government might be increasing the interest rate, and that means the bonds prices will come down. So what you could do is, instead of actually selling the bonds that you have, you could go short, or you could sell in some of them in the future, right? So through a derivative. But that derivative is like a standardized hypothetical bond which is not linked to any one particular issue, but it allows for more than one bond issue to be delivered, right? So it's like a averaged bond, you can say, of all the outstanding issues. And you will get to know more about this, especially in level 2, that what this means. But for now, just understand this, that the derivative is based on this hypothetical average bond of all the outstanding bonds, because there are lots of different outstanding bonds at any given point in time. Now, you can also have a derivative based on interest rates, right? Let's say you have a large project for which you have taken a very large loan, and you're worried that interest rates might go up. And if interest rates might go up, then your project might not be feasible anymore. So you're worried about a large project which is currently feasible at the current interest rate, but if the interest rates go up, your project might become unfeasible, right? So it will be not feasible if the interest rates go up. So what you could do is, you could get into a derivative as a long party, and if the interest rates will go up, then this derivative will be in profit for you, and which will offset the loss in your project, and therefore it will stop it from becoming not feasible. And you could also, by the way, get into interest rate swap. So again, with this large project, even though we have got a loan, we've got a large loan at a floating rate. Now, what that means is that the bank is saying, if the interest rate will go up, I will charge a higher rate. If it will go down, I will charge a lower rate. And what this floating rate is based on, something called the market reference rate, right? That whatever is the market reference rate, we're going to charge that. And how do we determine? It's based on daily average of observed market transactions from the secured overnight financing rate, which is an overnight cash borrowing rate collateralized by the US securities, which means banks, how much they are charging to each other for lending to each other, right? That is what is used to calculate what is the current floating rate, and that is what the bank is charging us on our loan. And if we are worried that, oh, what if this goes up and our project becomes unfeasible? So what we could do is, we could get into an interest rate swap where we pay a fixed rate, and the other party pays us this floating rate, whatever it is, and then we are very easily able to pay that floating rate to our bank, right? So we don't have to worry about what the floating rate is because somebody else is paying it to us and we just have to pass that on to the bank, right? And what we have to pay to this party is a fixed rate. So this is known as a interest rate swap. You could also do this for currencies. So remember I told you about the Mexican peso. Let's say we're doing an investment in Mexico and we're worried that the Mexican peso might become weak, right? And we might get less US dollars when we get our money back. So what we could do is we could get into a derivative which will help us hedge the exposure of this. So let's say we are worried that we're going to get back 100,000 Mexican pesos, and currently that converts to, and I'm just giving you a rough estimate over here, let's say that converts to 10,000 US dollars, and we are worried that later on the Mexican peso might become weak and we will only get maybe just 9,000 US dollars. So what we will do is we will not leave this to chance and we will lock this rate from now, which is 10 Mexican peso to 1 US dollar, right? We will lock this rate using a derivative contract. So we will sell these Mexican pesos in advance already, even though we might be receiving this maybe after 1 year, that we will get our money back after 1 year from this investment that we have done. So let's say the investment that we are doing right now is 90,000 Mexican peso, and after 1 year we are going to get back 100,000 Mexican peso. So we are already selling this in the future, that this 100,000 Mexican peso will get us 10,000. So we're securing ourselves. Now, commodities can be soft or commodities can be hard as well, right? So soft commodities include cattle, corn. Hard commodities include oil or metals, right? And think of the American Airlines example that I gave you, that they might purchase oil in the future because they're worried that the fuel cost might be going up. And that is one example that is there for a hard commodity like oil, right? And what about the soft commodities? So can you think of somebody who would want to sell corn in the future? Maybe a farmer, right? And I mean, don't think of a small individual farmer. Think of a corporation that does farming at a corporate level, right? Or think of like a big company that does like think of a Brazilian meat producer, a big corporate company that is producing and selling meat. So they would like to sell the meat in advance so that they can lock their profits and they can work out their costs accordingly. So commodities producers and purchasers. So American Airlines is a buyer of a commodity, oil, and these guys are a seller, right? And if we talk about oil, then an oil refinery is a seller. So they will want to lock their selling price as well, right? So they will go short on this contract, and here American Airlines will go long. Think of gold mine and a jewelry producer. The gold mine would like to go short and the jewelry producer would like to go long. So producers and buyers of commodities use derivatives to hedge their price risk of the commodities. Now, credit, and I gave you the example of a bank. Let's say a bank has a very large loan. So this is Bank of America, and they have a very large loan that they have given to American Airlines. And they are worried that because of COVID lockdowns, the American Airlines business is not doing that well. So what if they go bankrupt, right? So what they do is they get insurance from American Insurance Group that in case American Airlines goes bankrupt, American Insurance Group is going to pay Bank of America. So this is what we call a credit default swap, in the sense that if the borrower defaults, then the person who will have a loss, or the company that is going to have a loss, will get paid by another financial participant. There could be derivatives on almost anything these days, right? So for example, let's say you are a ski resort in Switzerland and you're worried that the weather might not be as good this year for skiing, and therefore less people will come. So what you could do is you could get a derivative based on the weather, depending on how much rainfall or how much snowfall there's going to be this year, or how long something is going to last, or even based on things like Bitcoin and all this cryptocurrency that we have. So almost everything is available in the world of derivatives now these days. Well, not everything, but a lot of things. So you can have several different types of underlying assets for derivatives these days.